U.S. equity markets extended their winning streak to 3 sessions today, but if you're just looking at the indices, you're kind of missing the real story.
Oh, absolutely. The headline wasn't just the gains, it was the total collapse of risk aversion.
You're talking about the VIX.
Exactly, the fear gauge. It plunged a remarkable 5.57%, closing at 14.08.
That number says so much. And at the same time, the S&P 500 gained 0.64%,
Yep, closing at $6,878.49.
which puts it just a breath away. I think it's 0.60% from a new all-time high.
It's right there. But the clearest, I'd say the cleanest signal of this surging risk appetite today wasn't even the S&P. It was the small caps.
Okay, let's focus on that, because that small cap outperformance is often, the canary in the coal mine for real conviction.
Precisely. The Russell 2000, those smaller, generally more volatile names, climbed 1.16% today.
And that closed at $2,558.78.
Right. And when you compare that to the S&P's gain, you get a positive spread of 0.52%. That 0.5% difference, that's capital rotating from safety into aggressive bets.
It's a statement that market participants think the coast is clear, at least for now.
For the next few sessions, at least.
Okay, that sets the stage perfectly. For this deep dive, we're going to unpack 5 really critical cross-asset dynamics from today. We'll start with that volatility implosion, move through a baffling paradox in the yen, and we have to talk about some truly historic surges in precious metals.
Let's get right into it then. That VIX at 14.08, it's a statement.
It really is.
When you zoom out, this daily decline means the index is now trading 76.58% below its 52-week high.
76%.
Yeah, that's not just compressed, it's practically flatlining.
So here's the question I always have when the VIX drops this hard. Is this genuine conviction, real faith in the economy, or is it just pure complacency setting in?
There's always a fine line, right? But the data today suggests it leans more into the conviction camp.
Why do you say that?
Because it's paired with that rotation into cyclicals, which we'll get to, and the Russell outperformance. Complacency is usually just high valuations without that capital movement. Here, we're seeing actual directional bets.
Okay, but there's still a risk here.
Oh, for sure. The risk of complacency is always there. If options traders think all risks are contained, they stop hedging. So if an unexpected headline hits...
The snapback could be violent.
Exactly. Precisely because no one is prepared.
So we have confidence, and it's being confirmed by the indices. The Russell's 1.16% gain puts it only 1.43% from its 52-week highs. But is this a fundamental bet or just classic window dressing before Christmas?
That's a great question. And while, aggressive buying before a holiday can look like that.
Portfolio managers boosting their returns.
Right. But there's a powerful seasonal factor here we can't ignore. We are officially entering the Santa Claus rally period this week.
And the history on that is pretty strong.
It's incredibly strong. Since 1928, this specific window has been positive something like 80% of the time. The market is leaning hard into that probability.
Okay, so that VIX reading wasn't just confidence in a vacuum. It translated directly into capital allocation. Let's unpack the sector rotation.
Absolutely. Today was a sharp departure from the defensive posture we saw earlier in the month.
Cyclicals were back in charge.
Completely. Money flowed directly into areas sensitive to economic growth. Financials led the way, up 0.88% to close at $55.32.
And industrials were right behind them.
Yep, rising 0.76% to $157.05. It's a clear signal participants are prioritizing growth, not safety.
And you see the mirror image of that story when you look at the laggards. The defensive plays got hit hard.
They really did. Consumer staples, which is what you buy when you're worried, plunged 1.14% to $77.88.
And that drop pushed it below both key moving averages, which is technically significant.
Very significant. Utilities also declined 0.38%. So this divergent cyclicals up, defensives down is the clearest proof of the session's risk-on character.
Now, here is where it gets really interesting for me because it seems to break the playbook. Real estate, it's rate sensitive, but the benchmark REIT index, VNQ, fell 0.40% to $88.24. And Treasury yields were only up a little bit today, so why are REITs struggling? It feels disconnected.
It is disconnected from the daily yield move. And that tells me we're dealing with structural headwinds here, not just daily rate sensitivity.
So something bigger is going on within the sector itself.
Exactly. The deeper you look, the clearer this bifurcation becomes. While the broad V&Q is falling, certain parts are surging. Look at Digital Realty.
That's a data center company.
Right, it's tech adjacent. It surged 2.35% today to $153.51.
So the market is saying not all real estate is created equal. The old school office buildings are struggling, but anything tied to tech infrastructure is riding a massive tailwind.
That's the structural shift in a nutshell. The demand for AI, infrastructure, data centers, power, servers is creating this incredible non-cyclical demand for specialized real estate. Meanwhile, the index is getting dragged down by the traditional properties.
Okay, shifting to the global picture, we saw a very unusual mix of asset moves today.
Yeah, a strange cocktail.
Equity strong, up 0.64%, but Treasury yields also rose a bit. The 10-year was up 2 basis points to 4.170%.
Okay.
But the thing that really breaks the pattern is the dollar. Usually, U.S. strength and rising yields means a stronger dollar, but the DXY fell 0.34% to 98.27. What's going on there?
That combination is definitely unconventional. The rising yields and strong equities point to economic confidence, but the dollar weakness suggests, well, it suggests a few things.
Like what? Profit taking.
It could be year-end profit-taking on crowded dollar long, sure.
Mm.
Or it might reflect a shifting view that the Fed's tightening cycle is absolutely done, which would weaken the dollar into 2026.
And speaking of underperformers, despite hawkish news, we have to talk about the yen.
The yen, what a paradox.
The Bank of Japan raised rates last Friday to 0.75%, the highest in 30 years. You'd expect that to strengthen the currency.
Profoundly.
And yet the yen kept sliding.
It's a huge paradox, and it shows the market's impatience with policy ambiguity. Despite that historic hike, USD JPY climbed another 0.93% today to 157.04.
So the market just shrugged it off because of vague BOJ forward guidance. What does that actually mean? What did the market want to hear?
They wanted a clear commitment to future tightening, a roadmap. They wanted the BOJ to say, this isn't a one-off, it's the start of a cycle.
I didn't get that.
They didn't. So investors interpreted it as a one-and-done move. And if that's the case, the yield difference between Japan and the U.S. stays wide, and the carry trade remains incredibly appealing.
So investors are selling the yen because they don't believe the BOJ will follow through, but that's pushing the yen into a pretty dangerous zone.
Absolutely. The pair is now approaching that 157 to 160 danger zone. That's the exact level where Japanese authorities stepped in back in the summer of 2024.
So intervention risk is now very high.
Very high. It creates this binary risk. Either the yen breaks through 160 and accelerates, or the BOJ steps in with massive dollar sales and we get a sharp, sudden reversal.
And that dollar weakness we were just talking about was a huge tailwind for commodities.
Oh, it's the classic play. A weaker dollar makes dollar-denominated assets cheaper for everyone else. WTI crude surged 2.31% to $57.97.
And copper, Dr. Copper was also up.
Yep, advanced 1.09% to $5.50. A good sign for global manufacturing health.
But the really eye-popping moves were in precious metals. Gold just soared, up 2.31% to $4,446.10.
That is an incredible figure. And what's more, it extends its year-to-date advance in 2025 to over 70%.
70%. That is a massive annual gain for any asset.
Transformative. But as notable as gold's move was, we have to talk about the most dramatic move in the entire complex today.
Platinum.
Platinum exploded, up 6.74% to $2,143.50.
It crossed $2,000 for the first time since 2008. 6% in one day for a physical commodity is huge. What drove that?
It's really specific to its industrial uses. The data points to two main factors. First, ongoing supply concerns in key mining regions. Second, some regulatory news out of Europe.
What kind of news?
It was seen as favoring combustion engines, which use platinum in catalytic converters, contrary to expectations of a super-fast full shift to EVs.
That's fascinating. A small policy shift driving a multi-percent move.
It shows how sensitive these markets are.
Now, one last thing on the risk-on theme. Despite all this enthusiasm everywhere else, equities, commodities, crypto was pretty quiet.
Very muted. Bitcoin gained only 0.19% to $88,304.
So that decoupling continues.
It does. It suggests that digital assets are operating on their own internal drivers now, not just as a high beta proxy for the stock market.
All right, looking ahead, we need to talk about technical levels and, more importantly, the looming liquidity conditions for this short week.
On the technicals, momentum is still overwhelmingly positive. The S&P is just 0.60% from its 52-week high of $6,920.34.
And $7,000 is that next big psychological number.
Right. All the indicators suggest the path of least resistance is upward, which aligns with that Santa Claus rally expectation.
But liquidity is the big caveat here. We have holiday-thin conditions, an early close Wednesday at 1 p.m. Eastern, and then the market is closed Thursday for Christmas.
And that can amplify moves in either direction. A big order in a thin market can really whip prices around.
That's the key risk. The market is fully positioned for this rally. The VIX is at 14.08. The technicals are strong, which leads to a really important question for you to think about.
What happens if the Santa Claus rally just doesn't show up?
Exactly.
If that technical strength fails to hold over the next few low-volume sessions, it could force a sudden panicked rush for hedges in a market with dangerously thin holiday liquidity. And that reversal could be sharp and painful.
A very provocative thought as we head into the end of the year. Complacency is often the most expensive trade. Okay, I think that covers the essentials for today's action.
That covers the essentials for today on the Daily Consolidation.
And as always, just a reminder, this is all for educational and informational purposes. It is not financial advice, so please do your own research before making any decisions.
And if you found this discussion helpful, remember to like and subscribe. We'll be back every trading day after the close to help you process the data.
See you tomorrow.
Bye for now.